Now, part 3, why does the United States of America do this to me? We're going to discuss the factors of systemic risk. We're getting into, as you can see here, I've got them up here. There are 2 very simple factors that contribute to this phenomenon of systemic risk, where Wells Fargo and banks like Wells Fargo cannot be allowed to fail, or rather, if they are allowed to fail, particularly an unexpected failure, there will be likely be a global financial crisis, catastrophic damage to the national economy and the global economy. We're going to get into that, but real quick, I wanted to make a note about this last video where I talk about I submitted my complaint, and they say I said to you that they had said that my evidence wasn't sufficient. What they said was that my complaint was not detailed enough and did not provide sufficient evidence for the Justice Department to do an investigation. Okay, so in other words, they didn't look at any of my evidence. I didn't send any of it to them. I was hoping to get a response for them to talk to me, and then I could go over it with them. As of March 25th, 2020, I have extraordinarily powerful evidence against this bank and its various accomplices. But to continue, we'll go over this first factor. The economy is financed. And what I mean by that is that the capital that banks provide to businesses is an essential component of the majority, the overwhelming majority of businesses in the United States. So you have small, medium, and then the large-sized businesses that probably upwards of 90% of them use bank financing. And the financing that the banks provide is every bit as an essential component of that business as the employees. It's every bit as an essential component of that business as the machinery and equipment that they have that produces their products. It's every bit as an essential component of that business as the real estate that a business owns. Okay, that a business can't operate without employees. A business can't operate if it's involved in anything that requires a machinery, whether it be technology equipment, manufacturing equipment. If that's a requirement to be in that business, a business can't operate without that. If a business has real estate that it uses for its operations in some way, a business can't function without real estate. Just the same, businesses cannot function without capital, and typically the capital is provided by banks. There are 2 levels of this. There's one is the long-term debt, where businesses, if a business needs to buy a piece of machinery and equipment, say it's a manufacturer, it needs machinery and equipment to manufacture its goods, or needs an extra piece of real estate, or whatever the case may be. We'll say, for our example, say it's a manufacturer that needs to replace a lot of its manufacturing equipment. Well, that manufacturer, that they're like most typical businesses, they don't have the cash on hand to outright fund the purchase. How businesses tend to work is they will keep enough capital on hand, enough cash capital, and that's another important point. Cash and capital are synonymous here, but they'll keep enough cash on hand to finance the short-term operations of the business, and then they'll have a buffer of about 50 or 100% typically. So a business might have twice of what it needs, to fund its ongoing operations in the short term, it's never typically not near enough to finance a piece of equipment, and so they'll go and get whatever piece of equipment they need, if it's a different business, whatever the real estate is, whatever they're getting, that's this large expenditure. And they will finance it through bank financing, and it will be a loan that is paid in principal and interest payments over a period of years. Okay, in the business, we call this term debt. Okay, when companies get long-term debt that consists of principal and interest payments over a period of years, that's term debt. And then at a different level, on a short-term level, going back to where I said that banks keep enough cash on hand to finance their short-term operations, a large portion of businesses, a significant percentage of businesses will have a shortfall during the ordinary course of business and they will provide on bank capital to supplement them during the periods of time that they have a shortfall. It could be due to a difference in timing between when they pay their suppliers, when their suppliers expect to get paid versus when the business gets paid by its customers. Okay, that if you've got to pay your suppliers before your customers, say you sell to your customers on a credit basis, that your customers are going to pay you in 30 days or 60 days, and your supplier wants to be paid right now, you've got to finance the gap there between those two time periods. And so, short-term capital keeps businesses afloat in those situations. And there are a lot of situations that apply, or that may apply. Some businesses are seasonal. Okay, so I worked for a small family-owned business when I was a teenager, and for a couple of years, a year or two up into my early 20s. And this was a restaurant that was right above the ski slopes in the place where we lived. And so the bulk of this business's money, this business makes probably two or three times more money during the roughly maybe 5 months that consist of the bulk of the ski season. 2 or 3 times as much money there in those 5 months as they make in the other 7 months. And so businesses that are seasonal, during the downtime, they may borrow money to be paid when the upswing happens. All kinds of scenarios like this. And in this sense, you can basically consider that cash capital is like the oxygen of a business. Okay, that a business that runs out of cash, the same thing that happens to a human being when a human being runs out of oxygen. That's what happens to a business when a business runs out of cash. I think of it as like cash is kind of like the oxygen of a business, and then energy is kind of like the blood supply. Is how I think it. And so, if somebody's a terrorist and they want to go after a country's economy and cause massive damage to it, where they want to target is the energy sector and the financial system. There's another aspect of this where the economy is financed that I'll briefly touch on, and that is that the economy, to a significant degree, relies on financial institutions just for transactions to take place. Okay, the transactions in the economy are very often facilitated by financial services and by financial institutions. And so this is things like payment cards, credit and debit cards, different electronic payment systems, all kinds of things along these lines, where certain transactions are that they're facilitated, they take place using part of the infrastructure of the financial system, and it may be the infrastructure of a particular bank, or it may be the infrastructure of the broader financial system as a whole, or there might be, like with the Zelle application, there are all these banks that own it. And so, you've got however many 5 or 6 banks own that, that are part of that system. So you can see, the banks like Wells Fargo play a very, very, very crucial role in the economy by providing financing, or actually, in what I've given you thus far, the information I've given you thus far, they provide an extremely important role to the customers that rely on them, all of these businesses. And I'm starting to get bad off here. I'm going to cut this video off. In the next video, we'll continue this analysis of the factors that create systemic risk. I'll continue to the discussion of that with the second factor, but I want to have to cut this video short.